I'm Matt Bishar with REIT.com here in San Francisco for REITWorld 2013, NAREIT's annual convention for all things REIT. Joining me for this CEO Spotlight is Steve Grimes, the President and CEO of Retail Properties of America. Steve, thanks so much for joining us today.
Thanks for having me.
Your company recently announced its first on-balance sheet acquisition since 2008. Why now for these deals, and do you expect more of this activity?
Well, thanks for the question. At the onset of the IPO, what we were looking to do first was to focus on deleveraging of the balance sheet. So with the offering and the preferred offering that we had done last year, with the opportunistic dispositions that we've done over the course of the last, call it 18 months, we were able to get to inside of our leverage level goal of 6 to 7 times net debt to EBITDA by midpoint of this year. It's currently at 5.9 times. At the onset of this year, we set out to acquire 100 to 200 million. And at the midpoint of this year, what we did is announce at our Investor Day that we were going to be looking to acquire in our select markets that we were targeting for the long term. In the third quarter, we announced that we would be exceeding that guidance to the tune of 300 million in total, roughly for the year. So we're very excited about the acquisitions that we have in the pipeline to date, but we remain very diligent in how we're approaching those acquisitions, making sure that we're looking to acquire in our select markets with the appropriate risk-adjusted returns.
And on the other side, the company also continues to refine its portfolio through dispositions. How have you found the market for selling assets, and how satisfied are you right now with the current composition of your portfolio?
I would say very satisfied with the current composition of the portfolio. We view our portfolio as institutional quality, and I think we're seeing that as we're looking to dispose of properties. These assets that we have slated for disposition are simply assets that are, core for someone else. They're well-performing assets. They've performed well for us in the past. They're performing well for us currently. But we're looking to narrow our focus in terms of markets as we outlined at our Investor Day. So we're looking to sell off opportunistically into the marketplace so that we can scale back in certain markets that we don't wish to gain scale. So the market has been strong. We have a pretty heavy quarter facing us as fourth quarter in terms of transactional activity, and we're very excited about the prospects.
And lastly, where does the company stand in the dynamic between pushing occupancy and driving rents?
Occupancy is interesting. We've had this question many years now. Occupancy has been really interesting for us because we held on to some vacancy in our anchor space, our better than 10,000 square feet of space. And given the fact that we're at 97% right now on a lease rate for the anchor space, we're seeing a lot of visibility, or the tenants in the smaller shop space are seeing a lot of visibility into what that center is going to look like longer term. So we've gained a lot of traction there. Year over year, we have gained occupancy gains of 360 basis points. And in just one short quarter, we moved our small shop occupancy to 84.6%, which is very strong for this portfolio. It's about 320 basis points improvement year over year. The dearth of supply has been helping in that regard, and the visibility of our anchor space, or our better than 10,000 square feet of space, being at 97%, position us very well to drive rents in our smaller shop space.
Steve, thanks so much for joining us today.
Thanks for having me.
For more on this and other REIT news and analysis, be sure to visit REIT.com.